So on this video, I'm going to be talking about investing as a beginner in the stock market. You are going to be investing passively. I'm going to tell you how you can invest passively and the instrument, the product that you can invest in to be a passive investor. I'm going to tell you how you can invest passively and the instrument, the product that you can invest in to be a passive investor. Why you keep on studying the market to know what it is that fits your risk tolerance level, what it is that you want to go through with on investing in the stock market. So as they say, where your money goes, your focus goes too. You want to know much more of what is obtainable in the stock market, having been looking at the stock market, be looking at some strategies, be looking at some stocks, be looking at some funds as well. So by just starting with a passive fund, it will spur and expose you to wanting to know how other sectors or how other products in the stock market work. So there are indexes. There are index fund and ETF. When I say ETF, I mean exchange traded fund that will give you niche in categories or size of a group of stock or possibly fund. So you can invest in some index funds that gives you broad exposure to the United States market or to European market or to Asian markets or to even African market. So there are indexes that meet such categories of investment. We start by just exposing ourselves to the US market, indexes on the US market. As you know, the United States is the biggest economy in the world, and there lies very much opportunity, even concerning stocks and investment products. So we look at the first index or ETF. We are going to be looking at an index fund with ticker symbol VTI. This is owned by Vanguard. It is the total of the entire US stock market for large caps to micro small caps. We basically own a piece of the United States of America economy, which is about 4,000 companies. These funds give you instant diversification across all public traded companies in the United States of America. So secondly, we'll be looking at the S&P 500. This is a stock market index that tracks the 500 largest publicly traded companies in the United States. These funds give diversified exposure to the 500 largest companies in the United States stock market. This particular index gives more niche in your investment of owning stocks in the largest US companies. You can buy SPDR SPY or Vanguard Group. That's for SPDR. The ticker symbol is SPY, that is SPY. For Vanguard, the ticker symbol is VOO. They typically have a low expense ratio of about 0.05% annually. On average, this gives about 10% return on your investments annually, that is. So the third index that we'll be looking at is ticker symbol VTSAX. This fund tracks the total US mutual funds market index. It holds virtually the entire United States market, from large caps to small caps companies. That also gives you instant diversification across different sectors and company sizes. It requires a minimum of $3,000 to invest in this index. Its expense ratio is 0.04%. That is very low. That's a very low expense ratio. Here, trades are executed only once a day. If you don't want to go into trading of stocks, there are even index that gives you opportunity to even trade on mutual funds market as well. So this VTSAX is a one-of-a-kind index that provides such opportunity. The fourth one, and my most favorite, is the NASDAQ 100. The NASDAQ 100 is a stock market index that tracks the 100 of the largest non-financial companies in the US stock market. This fund gives exposure to the 100 biggest companies that are tech heavy, and it is often seen as the measure of the United States tech sector's performance. You can buy Invesco QQQ or Vanguard VGT. So in this sector, that is the tech sector, you can buy Invesco. Invesco is the company. The ETF ticker symbol is QQQ. Or you can buy Vanguard. Vanguard is the company, while the ticker symbol is VGT. They typically have an annual expense ratio of 0.2% and 0.1% respectively. So QQQ has an expense ratio of 0.2%, while VGT has an expense ratio of 0.1%. So VGT's expense ratio is more cheaper than that of QQQ. QQQ holds 100 stocks, while VGT holds about 300 plus stocks. VGT is more tech heavy, thereby accommodating so many new companies in the tech sector. It is more volatile than QQQ. So there is more upside potential for VGT, but also more riskier as it holds much more smaller cap stocks that could fail. QQQ holds more blue chip stocks, and it is not only tech focused. It also holds large non-financial companies. QQQ gives more balanced exposure. I should just mention right now that I hold this ETF. I hold this fund. So by investing on QQQ, you have exposures to other bigger companies, but that are non-financials. You have some consumer goods companies still in QQQ, as well as very much tech companies. So if you want to go more passive, there are also dividend-paying funds that pays dividends while you hold that particular fund. So we have different indexes or ETF, exchange-traded funds, that could be paying you dividends while you are holding their fund. First of all, we have ticker symbol VIGI. That's owned by Vanguard. It's the Vanguard International Dividend Appreciation ETF. VIGI is an ETF that provides exposure to non-United States companies with a track record of growing their dividends. This dividend yield is about 1.9%. Its geographic coverage includes developed markets like Europe, like Japan, like Canada, etc. Its expense ratio is very little, as 0.1% annually. This fund is suitable for someone that wants to get exposure to international markets, and that could be European, Asian, or whatever other continent of stocks or company you want to own. So the second dividend paying ETF is ticker symbol VYM. This is a United States based exchange traded fund that tracks the performance of the high dividend yield index. This index is composed of US stocks that are expected to have above average dividend yield. It has very low expense ratio of 0.06% annually. Its dividend yield is about 2.6% annually. In my opinion, because of the high yield for dividend on this particular ETF, it is a simple set and forget kind of fund. Meaning the moment you buy it, you just forget about it. Then annually they'll be paying you a particular amount as dividend. That is 2.6%. So the more fund you own of this particular index, the more you'll be paid as dividend. If you can relate to any of this and you are getting value from this video, please hit that subscribe button now, and don't forget to like and share this video with that person you know that needs to see this. So now let's get back to the video. So I'm just going to add this here because I'm very big on AI, artificial intelligence, robotics, machine learning companies. So there are also AI ETF that we'll discuss here, that if you have such interest as well, you should look into it. So number one, we have ticker symbol BOTZ. This ETF majors on robotics and artificial intelligence. If you believe the robotics, automation, or artificial intelligence theme will grow significantly, BOTZ gives you a diversified basket rather than picking one company. This ETF has global exposure consisting of Japan, United States, Switzerland, etc. A whole lot of AI companies or robotics companies or tech companies. from different geographical location has their companies in this particular ETF. This expense ratio is quite high at about 0.68%. So that's a very high expense ratio that is being charged on this fund annually. So number 2 AI ETF that we're looking at is ticker symbol ARTY. This is a robotics and AI ETF. It's owned by iShares. This particular ETF offers global exposure to companies poised to benefit from the robotics and artificial intelligence integration. This ETF is suitable if you believe strongly in the AI team and if you are comfortable with elevated risk. Its expense ratio is 0.47%. It's on the mid-range, but I would say it's a little bit, in my opinion, is an ETF, so you are going to hold it for a long time. I do not see any reason why an ETF expense ratio should be above 0.3%. If it's above 0.3%, then it's slowly moving towards the high side. So this sort of fund holds more risk and more possible upside. As it poses more risk, when that particular sector starts getting very much exposure, start getting very much use cases, start getting very much adoption, the stocks itself will start going up. The stocks will pick up an upside trend and you stand a better chance of making very much percentage gain in your investment. So the third ETF that we'll be looking at is ticker symbol WTAI. This is an ETF that seeks exposure to companies globally that are heavily involved in artificial intelligence and innovation. If you believe that AI will be a major structural driver for future earnings and want to allocate accordingly rather than picking individual stocks, I think this is one of the ETFs that would suit you. Its expense ratio is 0.45%, still quite on the high side. It focuses on technology and communication services. This is a highly risky product and also holds very much potential for growth. This means that you also have a high chance of making a large percentage gains or profit in your investment. On this particular type of sector, we don't even use percentage, we use times that make 2 times, 2x, 3x, or even more, depending on what you want to accommodate. So the fourth and final AI ETF that we'll be looking at today is called AIQ. So this is a growth-oriented thematic ETF that gives you exposure to companies involved in AI and big data globally. So this particular ETF is not restricted to the United States market alone. It's a global ETF company. It is a higher risk play as well as a higher potential return. There's global exposure beyond large market caps in the United States stock market, meaning that there is much more companies from other countries that they have their stock in this particular fund other than the companies of the United States. So its asset under management is about 7 billion. It has a high expense ratio of 0.68% annually. The asset under management, AUM, is the amount of funds that this particular company manages only on AI sector. So with this, I believe you got valuable information on AI and the stock market in general. So if you are thinking of starting investments in the stock market, you should very well consider this technique by just investing passively, while over time you learn and know how the stock market works. It will help you a great deal than just sitting by the side and waiting, procrastinating. By so doing, you are missing out on whatever it is that the stock market has to give to you, whatever gains that there are, as well as losses, because at one point in time you may lose, but on the large trend, you stand to make profit. So if you got valuable information from this video, kindly do me this favor and subscribe to the channel, like this video, share this video with someone that you know that has interest in investment but does not know where and how to start that journey of investing in the stock market. So with that said, I appreciate you and I see you on the next video. Cheers.